Sorry.
Okay.
Kids. Seems like no matter what, I'm tucked away upstairs, you know. They know I'm recording. It's urgent. We've got to talk to you. Okay. So when you make a sale, it's 2 entries. And when they return it, it's 2 entries because you're either recording the sale and taking it out of inventory or you're recording the return and putting it back in inventory. And there's always, the allowances hardly ever show up. They're really rare. So I would make note of what the journal entry looks like, but I wouldn't stress about it. You're probably not going to see them.
Okay.
Let's see. Before we get into any of this, let's kind of look again at this. When you make, sorry, hitting the touchpad too much. You can have sales. I'm just making up a number. But then when the stuff gets returned or you give a discount, that kind of changes that sale number. You would have maybe $500 in discounts and maybe $1,000 in returns. So we would say that the net sales would be $8,500. That makes sense?
Yeah.
So we originally thought we sold about $10,000 worth of stuff, but by the time we gave them some discounts and some of it came back to us, we really sold $8,500.
Okay.
There are some story problems that are going to make you work through that math. They'll give you some of these numbers and make you find a missing one.
Okay. Okay, gotcha.
Straight up, you would have to find net sales, but they're probably going to mess around and say, here's sales and here's net sales, now find discounts.
Okay.
Yeah. So they'll leave one number out and make you find it. But that's the beginning of the income statement. We say this is the true amount of the sales. So when we were talking up above about sales minus cost of goods sold gives you gross profit, this really should say net sales.
Okay.
The stuff that really ended up being sold. So that will help you with that. And I wanted to show you something that was in the book before we go on to another concept, and that's in the homework. You're going to have questions kind of like this quick study at the bottom, where they're going to give you sales discounts, sales returns and allowances, and then cost of goods sold. And they want you to find gross profit. Well, they also want you to find net sales. So net sales is taking the sales, minusing the discounts, minusing the returns, just like we just did, and that'll give you net sales. And then net sales take away the cost of goods sold gives you gross profit.
Oh, okay. So net sales minus the cost of goods sold is the gross profit.
Yeah. Come up here. Net sales minus cost of goods sold gives us gross profit.
Gotcha.
Okay. So it took a little to get net sales. We had to start with sales and take away the discounts, take away the returns. We finally get to net sales. But once we get net sales, then we can subtract cost of goods sold and determine our profit.
Okay.
Okay, so back to the textbook and completing the accounting cycle. Wouldn't worry too much about those. You'll see a little about that, but the closing entries, like the chapter 4 stuff, all they're talking about here is that just like chapter 4, you still have to close the books. So you close the revenue, but the revenue account has changed names. It's not called service revenue anymore or fees earned. It's
okay.
But it's the same entry.
Okay.
Then the second entry, you are closing all the expenses and a couple other accounts. You have 3 new accounts that you didn't have when you were a service business. You have sales discounts, sales returns and allowances, and cost of goods sold. Those are also debit balance, so they get closed just like an expense that's a debit balance account. And then you can see from this diagram, there's no more red accounts. That's because the third and the fourth closing entry are exactly the same as what you learned before.
Okay.
Just a little difference to those closing entries because you're adding accounts that you didn't have before.
Okay.
And this next page is awesome. It is a summary of all the different journal entries we just talked about.
Yeah, I like that.
Yeah, good page to flag with it or make a photocopy of or something.
Yeah.
Oh, and how the income statement looks. You can make an all big fancy income statement and it looks overwhelming, but it's not as bad as you think. These first 4 or 5 lines are the calculation we talked about.
Mm-hmm.
Starting with sales, taking away the discounts and returns, getting the net sales. Awesome. Cost of goods sold, and then gross profit. So you take away the cost of goods sold, and you can determine what the gross profit is. They take time to list every single one of their expenses, and they just put them into 2 categories, whether they were about selling the product or running the office. But there's still just a list of expenses. They just kind of group together.
Okay.
So there was $71,000 worth of expenses, and we only had $84,000 profit.
What is the difference between rent expense selling space and rent expense office space?
Renting the office, wherever we have our office, whatever we pay for that building, and whatever we pay for where we have the store. So if they're in the same building, then they probably just split the bill and decided the office takes up 2/3 of the space, so they get 2/3 of the rent or something.
Okay.
But it's all just a matter of whether it happens in the store or happens in the office.
Gotcha.
So after they took away all those expenses, they're down to just under $13,000. And they have a few random things down here that you don't need to worry too much about. You're not going to see much of them. They're just other miscellaneous junk that might happen in the business. And then you finally get profit. The biggest things you need to know are up here. How to get to net sales, how to take away cost of goods sold to get gross profit. Then you take away all the expenses and you get to income from operations, which is generally net income because most companies don't have this. This would just be blank, so the same number would just come down. Occasionally you'll get one that has some of this miscellaneous stuff that you got to add or subtract. But I don't think that's going to be much of a problem. I think you just worry about the stuff up here and follow the format of it. And that's pretty much it for Chapter 5.
Awesome.
Chapter 6 looks at a merchandising business and how they keep track of their inventory. There we go. Okay, that's, yep, you know what, I think I will go and try to see if I can steal a story problem out of here versus making one up. It just makes the math work out a little easier if I'm not thinking it through and trying to create the problems myself. Find a good story problem to steal information from. Here we go. This might even be a homework one. I steal a lot from the exercises in the back of the book. But exercise 6-7 tells you all kinds of junk that happened in the company. These charts can be really overwhelming to you to learn how to kind of just, okay, what do I need to look at? What it's trying to say is that this company only sells one product. Not realistic, but it helps the story problem be easier. So on January 1st, they had 200 of those products on their shelves. They had bought them for $10 a piece. So they would say their merchandise inventory was $2,000 on January 1st. January 10th, they sold 150 of those products. So they had 200, they sold 150. So by January 10th, they're down to 50 products on the shelves. So March 14th, they buy a bunch more. But the price went up. Wherever they buy from whatever supplier, the supplier really raised the price. But now they have 400 products on the shelf. Then they sell 300. Then they buy some more. Then they sell some more. Then they buy some more. So all throughout the year, they had a total of 1,100 units. Not all of them are still here, but they had 1,100 at some points during the year. They've sold 880. So if I do the subtraction, it's 220 products are still here at the end of the year.
Right.
That makes sense?
Yeah.
Okay. Our job is to try to figure out the cost of goods sold. So I'm going to try to split the screen here so we can kind of look at two things at once. I know it's going to make the print really small. Do you happen to have your book handy so you can kind of follow if the numbers are too small?
Yep, I got it.
Okay. So we're going to look at that same story problem, but I want to have some space to actually write it out. Here we go.
What page is that?
274. On January 10th, we sold some merchandise. So we'd make an entry. Accounts receivable and sales. But remember, we have to make a second entry every time we make a sale. So there's our two entries that we would make on January 10th, the day we make a sale. The only problem is we also have to record how much we sold, the dollar amounts for these sales. So accounts receivable and sales are going to be at the price we charged our customer. Well, we sold 150 products at $40 each. So if I do the math on that, 150 times 40 means we charged $6,000 for the merchandise that we sold. That okay?
Yes.
Okay. Now we have to take the cost of the merchandise, what it cost us for those same 150 products. So we have to look at what's in inventory. Well, they had to come out of this group because that's all we had. Mm-hmm. So they must have cost us $10 a piece. That makes sense?
Yes.
Okay. So we I use scratch paper just to keep my head screwed on straight. I now have 50 at $10 left in inventory because that's all I have until March 14th when I buy some more. Then on March 15th, I make another sale. So I'm going to do these same journal entries again. But of course, the dollar amounts change. I sell 300 products at $40 a piece. That's $12,000. and I'm going to charge my customer for that stuff. But what did they cost me when I bought them? Did I cost me $10 or $15? Because that's the two choices. Some of the stuff that's on my store shelves cost me $10, and some of it cost me $15. And unless I have stickers on them or something, it's going to be hard to keep track. I know you said something, but I wasn't able to hear you.
Don't you always want to go with the higher amount?
No, we are actually going to do we're going to make a choice as a manager of our business on how to keep the records. And if you look in the textbook right next to where it says exercise 6-7, it says perpetual inventory costing methods, FIFO and LIFO. Those are two possible ways we can do things. And this problem is going to ask you to do it both ways.
What does those stand for?
Yeah. FIFO means first in, first out.
Okay.
That means the first stuff that came into your business is assumed to be the first stuff you sell. So that would say that these 300 that we sold, the first thing would be we would sell the remaining of the old $10 stuff.
Okay.
And then the rest would be from this group. So we sold 300. So that would say 10 of them were at, 50 of them were at $10 each. And the other 250 were $15 a piece. So that's what we would say were in that 300 that we sold. Because our first priority was to sell the really old stuff and then to sell out of the $15 group.
Oh, gotcha. Okay.
Okay, so if we do 50 times 10 and 250 times 15 and add them up, we're going to say that that was a total of $4,250. If we do it FIFO. If we keep going with that and we go down and do the October 5th sale, we would do the accounts receivable sales again. And we sold 430 products at $40 each. So that would be $17,200. So that's never too bad to calculate. But it's always this cost of goods sold that's hard to come up with. So we have to figure out which products we would consider sold. So FIFO is going to say that we should sell the other 100 at 15. That $15 group, we bought 350 of them originally at $15 a piece way back in March.
Yeah. And
we just decided earlier that we sold 250 of them, so there would only be 100 of them left in October to sell at this point. And out of the 430 that we sold, 330 must have come from the $20 group. We'll do. So we'd say the sale was $8,100. Would be the cost of the items we sold that day.
So the only time we do the FIFO or LIFO is when we make a purchase.
When we make a sale.
Yeah, I mean, yeah, sale. Okay.
Right. Exactly. So the purchases are just going to be merchandise inventory and cash, or merchandise inventory and accounts payable. So we're focusing more on this. And they probably won't be making the journal entries as much in these story problems as just determining the cost of goods sold.
Right.
So to answer the question, it says, what is the cost of goods sold? you would have to take the cost of goods sold from each of the sales. So we'd go back up and say on our very first sale, it was $1,500, then it was $4,250, then it was $8,100. So $1,500, $4,250, and $8,100. So our cost of goods sold is $13,850. And what's left in ending inventory, in other words, the stuff that didn't get sold, we'd have to go back through. Well, we sold all that stuff. We sold all the purchases of March, and we sold a bunch of the July, but not all of them. We sold 330 of them, so we'd have 220 left. 220 at $20, and we'd still have the 100 at 25. Not liking my at symbols here. Okay. So we do the math to figure out what they were. 220 at 20 and $2,500. So we'd say our ending inventory was $6,900. Okay. Sound halfway reasonable?
Yes, ma'am.
Okay. LIFO isn't much different, except it works opposite. LIFO is last in, first out. So the most recently purchased stuff is the stuff you sell first. Sounds a little weird. The best description I've ever heard of picturing how that could happen would be one of those places where you can buy gravel and sand and even dirt. You go there and they have this huge pile, and if you want so many yards of it, they just scoop it off the top of the pile, put it in a dump truck, and bring it to you.
Yes.
Well, after they sell a bunch, they get a new shipment, and it makes a huge dump on the top of their pile, and then they start selling again, and they're selling that newest, freshest stuff at the top of the pile, and they're really old. They've had it forever inventory is at the bottom of the pile that probably nobody ever gets to unless they really sell out. But who cares? It's rocks, it's sand. We don't care if it sits there for 6 years.
Right.
And we'll keep selling the fresh stuff. This would matter a whole lot if we were selling heads of lettuce and
Right.
fresh milk and stuff. The neat thing about it, though, is in accounting, companies can choose to use LIFO or FIFO, and even if it's not the way their products actually go out the door. So you can sell milk and lettuce and stuff and use LIFO because it's all about how you allocate the money. It's really not trying to say this is how the merchandise actually sells.
Okay.
Okay. So LIFO, those same sales. Let's go back up and look at LIFO. The first sale wouldn't be any different. January 10th, you only had one thing to possibly sell, the $10 stuff.
Gotcha.
You didn't have a choice. But the next one, you did have a choice. You had 50 of the $10 ones still around, and you had all 350 of the $15 group. I'm sorry, this just keeps ringing.
That's okay.